Renting sucks. While it can have its advantages, I'm sure most of you, given the choice, would rather pay money into something you own rather than giving money to a landlord every month. In this video, I'm going to show you how you can escape the rent in your 20s, buy your first home, and leverage that ownership or bright financial future. I'm 𝐬𝐮𝐬𝐫𝐞 Mortgage Guy. I've been a loan officer for 17 years, and I'm here to show you the secrets I use every day to get people just like you from renting to ownership. Thanks for watching. Before we talk about rent, we need to talk about debt. Debt is our key factor to ownership. While we often talk about debt negatively, we can actually use it to our advantage. The easiest way to accumulate the kind of debts we don't want is buying things we don't need with the money we don't have. That means you need to sit down and really build out a budget that works for you. I'll have a video on how to budget in your 20s linked in the description, but for now, let's talk about good debt and how to use it to your advantage. It may not feel like it, but a student loan is a good example of good debt. This is because you own your degree. Provided the degree is useful and you're able to make your payments on time, the debt you took out at 18 will serve to make you more money across your lifetime. You can also use this debt to build up your payment history, which will reflect positively on your credit score. This is just one way we can use debts to our advantage to get you ready for home ownership. Think of your credit score as an exam or a final project. Obviously, the 3-digit number is your grade, but credit reporting companies use a specific rubric to determine your final grade, the credit score. Let's break it down. First is your payment history. This is the single most important factor and accounts for 35% of your grade. It reflects how consistently you've made payments towards your monthly debt on time. Even one late payment can significantly damage your score. Next is the amount owed. This accounts for 30% of your grade, while payment history accounts for your loans and other open credit lines. The amounts owed is solely focused on the credit you're using versus the credit limit. This is what's known as credit utilization ratio. Ideally, you should keep this number below 30%. So let's say you have a $300 limit on your credit card. That means you should avoid spending more than $90 on that card within a billing cycle. A high ratio, especially anything over 50% utilization, indicates you may be overextended, which can hurt your score. If you have to go over 30% utilization, be sure you make those payments, and if you can, pay it off to avoid accruing any interest. The third factor is the length of your credit history. This accounts for 15% of your grade, but is still a major factor. When you add this up with on-time payments and low utilization, lenders like me can feel confident working with you, even if your total income is less than ideal. The last two sections account for 10% of your grade each: new credit and credit mix. New credit is how much new credit you apply for within a short period of time, and this implies some instability that lenders don't like to see. Your credit mix are the types of debts that you have. If you can responsibly manage multiple kinds of debts, this is a good look. Ultimately, these are still important to your overall credit health, but when you're just getting started, focusing on those top 3 sections is what's most important. Also, note that these percentages are averages and may slightly vary depending on the specific credit score models being used. So for instance, FICO is used by mortgage companies, and VantageScore, which is a consumer scoring model, is used by services like Credit Karma and Rocket Money. And typically with the VantageScore, it is going to reflect a higher score than what lenders typically see because of the different score ranges. So be sure to reach out to your lender so that you can get an accurate representation of what your true FICO score is. Now that we've got a better understanding of debt, let's talk about rent. Renting is a trap. Sure, it's comfortable at first, and it probably feels great knowing that you can manage to pay $1,200 a month for your own place. But this comfort can quickly turn into stress as years after years, your money seems to continue to slip away, inflation rent increases, your rent increases, and your sink still leaks because no one bothers to fulfill your maintenance request even though you put it in months ago. Think about it. If your rent is $1,200 a month over 5 years, you've essentially wasted $72,000. Now, let's look at this house. This starter home right now is worth $316,000. 5 years ago, it was actually worth $181,000. So if you've owned instead of renting, you would be up over $181,000 thanks to the equity you invested into your home. And guess what? There's still sub $200,000 homes on the market that are perfect for you to invest in right now. If you're in this trap now, the best thing to do is to find a way out. That's what this video is here for. That's what my channel is here for, to help you escape this financial downward spiral. If you're ready to take that first step, head over to my website, 𝐬𝐮𝐬𝐫𝐞 or use the link in the description to get in contact with me and my team. We're here to help. Now, I know the rental trap is easy to get into, which can actually make the path to home ownership seem confusing, expensive, and not worth the effort, but this is just wrong. The home buying journey is not an easy one, but it is one of the most rewarding financial decisions you can make and will change your entire life. And it only takes 5 steps. Step 1 is get pre-approved. Know your budget and bargaining power by securing a pre-approval from a wholesale mortgage lender. lender. Step 2 is to find a home. Work with a realtor to find a property that fits your needs and budgets. Consider fixer-uppers and land for potential deals, as renovations and new construction loans are options as low as 3% down. It may not be your dream home, but it is an important first step. Step 3, make an offer and negotiate. Submit a formal offer outlining your purchase price and terms. Negotiate with the seller to reach a mutually agreeable deal. Step 4 is underwriting and closing. This is where the lender actually verifies your financial information, and once approved, you'll finalize paperwork and secure homeowner's insurance. Finally, step 5, congratulations, you're a homeowner. Sign the closing documents and receive the keys to your new place. Be prepared for ongoing costs like property taxes and maintenance. That's it. We could go into details, but I've actually covered these in videos all over my channel, so be sure to head over there, hit subscribe, and I'll have some links in my description to help you get started. Of course, no one is expecting you to buy a house cash, but if you need a realtor recommendation, there will be a link for you to click in the description down below. Most times when you talk about buying a home, what we're talking about is about securing a loan. This is another type of good debt that over time will lead to better financial standing. There are 4 primary types of loans that we use, and each one of them have programs and variations that they offer depending on your situation. Let's talk about government-backed loans. First is my favorite, the VA loan. This loan is for qualifying members of the U.S. Armed Services or retired. They're willing to work with you even down to a 500 credit score, and you could pay potentially 0 down. Next is an FHA loan. This loan is actually backed by the Federal Housing Administration and was designed specifically for first-time home buyers. If your credit score is 580 or above, you could qualify for a 3.5% down payment. And the last government-backed loan is the USDA loan. This loan is backed by the U.S. Department of Agriculture and are designed to promote homeownership in rural and otherwise specified areas across the country. Depending on where you want to live, you could actually secure this USDA loan with as little as 0% down. There will be a link below to the eligibility map or the USDA website. The last loan we're going to talk about are conventional loans. These are backed by private lenders and the most common mortgage loan. If you're able to meet the income requirements and maintain a credit score above 620, you'll be in really good spot to benefit from the special programs that conventional loans can provide. Each loan type has its own advantage and limitations. Finding the right one is going to depend on you. Your credit score, your desired down payment, your ideal property location will also help determine the best fit. Once you have an understanding of both your wants and your needs for your first home, you need to consult with a qualified mortgage lender. You're not alone on this journey. Experienced mortgage lenders like myself spend day in and day out poring over loan documents and programs to have an intimate understanding of them. We also spend a lot of time looking over financial records and bank statements, which you need to provide all of so we can get the clearest picture we can. Remember, there's no one-size-fits-all solution. It is important to work with your loan officer and be completely open with them. Remember to shop around to get the right fit, but remember that when you choose a wholesale lender like myself, you stand to save over $9,400 over the life of the loan and up to $10,400 for minorities over the life of any mortgage loan you choose when going wholesale. I hope you're starting to realize that home ownership is not an impossible goal, and that when you put your head down and do the work, it's a lot easier and cheaper than you think. I want to personally thank you for watching this video. If you learned something, leave a like. It goes a long way to sharing my knowledge with other renters just like you. If you have any questions, leave a comment down below. You may get a video response. If you're ready to take the next step to breaking free from the rental trap, here's what you need to do. 1, subscribe to the channel. There's a lot of valuable information on there and it would help me out a lot. Number 2, click on the link in the description below to schedule a free consultation with me to evaluate your options and for you to get started. If you're curious about your buying power, use our free mortgage calculator link below to estimate what you can afford. And click the video on screen now. I know you'll like it.